everyone. Thank you so much for joining. I know we still have some people joining in, but nonetheless, appreciate everyone spending their time today. And I'm really pleased to welcome some of our panel speakers. Uh, the topic for today is quite interesting. Well, we've last couple of, since yesterday morning, we've been hearing a lot of regulation, fintechs, banking space. I think one of the space that was critical to also look at was financial risk and compliance, AML space, and emerging risk. And some of our leaders here who are experts in this field are going to share their insights of what they think, what the stage is set today, and what do we think we should be prepared for in the coming years and months to come. But before we start with the session, I'd definitely like to ask each of the panel leaders to just give a quick brief about what they're into, what are the expertise, and then we'll dwell deeper into some of the key questions that we have in our minds. Feel free to ask a question at the end of the session if there are any. We'll be happy to take them. All right. But before that, thank you so much, everyone, for joining the session. Let me start with Sandeep. I know you've done some amazing work in your field of forensics and risk investigation. It has always interested, a topic of interest for me because I love watching these forensic and investigative kind of series and reading novels. But let's hear from the expert. And yeah, please go ahead, Sandeep.
Thanks first for inviting me for this session. Good to see all of you. I think my background is I'm with ENY for 25 years now, and doing forensic for more than 2 decades. And especially in the fintech industry, I think last 3 years been involved in most of the forensic diligences and investigations that have happened when investors actually invest into fintech companies, and a lot of trigger-based investigations that have happened. So we get to see what is happening at the back end in terms of different types of challenges and then frauds that you see and the regulatory challenges. So that's how I'll summarize that.
Thank you, Sandeep. Badri, over to you.
Hi, good afternoon, everybody. I'm from Turtlemint. Turtlemint is an insurtech. We build technology platforms for distributing retail insurance products, whether it is auto or life or health. We built one of India's largest agent networks, about 2.5 million registered agents, about 3 lakh certified agents who present across 19,000 pin codes. So we do a lot of transactions through distributed DSA kind of a model through the agents. Or we work with banks and enabling them to sell insurance. This topic is of amazing interest to us because while the regulator wants us to grow the industry such that every Indian is insured by 2047, which is the 100th anniversary of India's independence, scaling needs to come with risk management. So it always feels like 2 steps forward and 1 step backward in trying to grow while managing the risks. So looking forward to the discussion. Thank you, Nirmal.
Thank you so much, Badri. Nishkam, over to you.
Thanks. I have been with Deloitte for 15 years now, and around close to 2 decades of my experience on FinCrime, helping financial services in managing FinCrime, investigations, frauds, quite like Sandeep as well. A good place to be here and talk about how fintechs are experiencing changes in the regulations, what challenges they are facing in AML as we help some of the clients fight these challenges from regulators and from industry what are coming their way. So happy to be here and sharing our thoughts on how we see what's happening in the industry and hear from you guys on what's your experience around that. If any questions, etc. Thank you.
Thank you so much. And finally, Abhishek.
Thanks a lot, Nath. So I am the CEO and co-founder for Zigram, and my background is that I've worked in the anti-money laundering, financial crimes compliance space, building solutions, building data globally for some of these risks. And a lot of my focus is on building high technology, high focus data assets to solve some of the risk and compliance issues that are often plaguing the fintech space. So that's really what I do.
All right. Thank you all. Thanks for the introduction. And that actually makes me wonder that, you can't have a better panel than this, where we have advisory services, we have consulting, we have solution provider, and then we have all of us as users. Makes us an interesting conversation. So let's kick this off, the session. Now, this for the entire group. I mean, when I was going through all of this and I was interacting with some of you in the morning, what intrigued me was since yesterday, we're reading a lot in the newspaper lately. We've seen an outburst of fintech space, especially in the last decade and a half, right? Before that, we saw that there were only banks, big financial institutions that were really into the play. But now that emergence of fintechs coming to this and offering payment solutions, banking solutions on the fingertip, on the go. I mean, consumer today is spoiled for choice, but regulators are not spoiled for choice. They are constantly keeping an eye on it. And we have been reading a lot lately, right? Do you think we need to strike a balance, there is thin, delicate balance we need to strike between the demand for growth and demand for need, right? What do you guys think? Because the way we have moved, and each of your domain, you would have seen something that there would be a trend that is showing, or the trend is yet to come, but we are seeing a little bit of bubbles on the surface of the water that could lead to or can amass some issues that we should be prepared of. So let's start with Sandeep. What do you think in this space?
So I think first I'll start with making sure that this topic itself is considered serious, which I think based on what I see over here, only few of you think that this is a serious topic. A lot of others don't, which I think is a challenge consistently that we have seen in this space, not just in this industry, by the way, in other industries as well. Business, marketing, sales takes the precedence. Compliance, regulatory requirements are more like, okay, tick in the box approach. But the way globally these practices are evolving, this is now a boardroom topic. So if you don't take this seriously, you would have significant challenge. So I'll start with that first. I think organizations need to understand that AML risk, regulatory risk in general, is a significant, sort of a challenge now in the current, environment. And there is a need to balance, like you rightly said, need to grow versus, need to also comply with the different, requirements that are there. So that's the first, challenge that we see. What happened in the last couple of days, as you see in the newspapers, is obviously people link it with a particular angle that because there is an investment from a country, that is why the apps were banned. But if you see several apps, they had no investment from that, country. But there are other non-compliances that were happening, which if you do a little bit of study in the public domain, look at different blogs, look at different consumer complaint forums, look at their own apps, reviews, and then the feedback that is there, you'd realize that this was coming. Because there is a lot of feedback, a lot of data that is, available, which maybe in some cases they are tracking, several cases they are not tracking. In some cases, the view is that unless somebody, takes it to a different level, till that time we'll manage it. There'll always be few people who will not be, happy with our service or would complain. But apparently in this case, what has happened is the relevant department got inputs from different states for each of the apps that are there, and based on that they were banned. Now, why again it is important to comply with the law of the land is if you are not complying, suddenly something may come and hit you very badly. So with no notice, you are out, you can't do any, business till you actually comply with those rules. So I would say that as the biggest challenge right now. Second, I think I would say is the disruption that is happening continuously. While I think a lot of changes have happened over the last decade and so, like you rightly said, but in the last 2 years, especially post-COVID, the way industry is going through a disruption is at a completely different level. And I feel again, especially in India, what OCEN, which is the Open Credit Enablement Network, which I'm sure somebody would have talked about in any of the sessions today or yesterday, that's going to again disrupt the industry. I don't know how many of you are looking at that, how many are looking at embed with that, process, but that's something again that's going to, change the way industry operates very soon. So I think stop at that.
Perfect. Thank you so much. I mean, that is interesting. But Nishkam, I mean, you have a view on that, more from your exposure to what you're seeing and how you're dealing with these things, and how institutions, individuals, how are they seeing this in their space according to you?
Sure. So I think complying with the regulations and has always been a challenge for fintech. And as fintechs have always been called as the disruptors, I think they are facing these reverse disruptions, if I can say, from the increasing demand from the regulators on how they operate and how they comply with the regulations, whether it's related to fin crime, whether it's related to other areas of cyber, etc. And RBI is not shy of mentioning that in their annual reports and any of the papers that they come out with, that fintech is a space where there is a lot of risk which is emerging out, and there is a lot of to be seen, a lot of to be done by the fintechs themselves, while regulator is also working on that. I think that always continues to be a challenge with the fintech. That, even the regulators are still evolving of what they want them to be as frameworks for whether it's financial crime, whether it's cyber-related matters. So that has been always a challenge here. Speed of transactions which happen, the volumes of transactions which happen with fintech, and the anonymity of the customer, right? Your customers are spread over. It's not like you go to a branch of a bank, the banker knows you, you've done a KYC, etc. in front of the customer, you know the customer back of your hand. I think those are some of the challenges which fintech does face when they have to comply with AML regulations. And the speed of transactions, the volume of transactions, the only way to counter this is to then use technology to monitor these transactions or identify these, and at a very early stage, so that while the USP for fintech has always been that the speed of transaction that they provide to their customers. I think if they are going to comply with, they need to comply with the fin crime regulations, etc. The technology is only going to be the key for them to get this as fast as done, so that their speed of transactions for the customers do not get impacted. Because we are seeing that kind of a downtrend when we talk to some of the fintechs. Because of the compliance issues, the time taken for transactions is really getting longer and longer, and then they are seeing a trend where their customers are moving out of those solutions, etc. That has always been a challenge. Yeah.
Perfect. I think you touched upon two things, speed of transactions and second, KYC.
Yes.
And both have, I think, has changed over time. With speed comes more technology solutions because everybody is trying to be in the race to offer something. KYC, by definition, has changed, where it is not just about giving your identification and address to going into more intrinsic information about you as an individual and your transactions and how things are being done in that ecosystem. But for that, there are a lot of these solutions that are there, but let me switch to Abhishek, because as a data asset solutions provider, how do you think, Abhishek, we are geared to handle some of the elements that they talked about within the data asset space and the AML and financial risk and compliance?
Sure. Thanks, Anand. So I'd like to actually break this problem down into two parts. For one, the solutions actually can be built, which is going to be a combination of data and processing power and the right applications and having the right algorithms, and regulators will go out and bless them, and then we'll start applying them. That's one part of the problem. And I think we can talk, ad nauseum about all of them. The one part that I actually wanted to bring apart, and something that we discussed just before we actually set up on the panel, which RegTech and technology can't solve for, cannot solve for, but actually can be a big, I'd say, enabler, is the fact that actually in India, anything to do with finance and lending culturally is seen in a very negative way. Right? So we were just talking about it. I mean, all these stories about India, coming under British rule was actually done by the bankers. That's the stories that we were told. That the Mughals were funded by some banker, that the British was funded by some banker, and then it extends into the 50s, 60s, and 70s, even until very recently, where the biggest villain that you had in a movie was the moneylender in the village, or somebody who was giving out a loan, somebody who was putting people under bonded labor, X, Y, and Z. So culturally, this has seen a certain amount of predicament when it comes to our country, and maybe that is why credit has also been limited. We don't have access to as much credit as we should have. That's one. Two is, now you are adding venture capital money, you're adding technology, you're adding mass distribution, you're adding KYC, UPI, all of that, and so it is hypercharging growth, which is great for people like us who sit in 5-star hotels and talk about this, but it's hypercharging growth in an area which is culturally was seen negatively. So you're going to face those challenges, and I think where tech actually becomes an enabler is if brands and companies end up taking the position that we are going to have the best risk processes, we are going to have the best KYCs, we are going to integrate that as a position in our brand, that we are secure, we are conservative, we are fair, we have all these risk processes. Those individuals actually and those companies may actually see themselves having a differential advantage from the competition in today's date. So I think there is a lot of technologies available and there are a lot of more will be available for risk. But I think now this is going to become a differentiator for brands and companies because everybody else is being looked at by 95% of this country as somewhat tainted because of the cultural background that we come from, where money lenders and lending is not seen as has traditionally not been seen as a very positive space. That's what I would say.
Thanks. But I think while there are a lot of technology solutions that are already available, I think most organizations think that what they already have is enough to safeguard them or to support them. Do you think, Abhishek, back to you, do you think that what they already have versus what they can do further complement their existing solutions can help them be better prepared in this space?
Yeah, I think that definitely can. I think the challenges are two, and we'll maybe touch upon this later as we have more conversations. One is the average fine that a regulator puts up on financial institutions and others in this country is very low. The highest fine, for example, for anti-money laundering that has ever happened in this country is about 5 crores for a public bank. Abroad, if you go, it's about $10 billion. Now, the position that the regulator takes is, this is public's money, the public ka paisa hai. So, main is pe fine lagaunga, to then I'm, putting a fine on the public. But what it is doing is, if the big banks are paying 5 crores, 1 crore, 2 crores, 50 lakhs, 25 lakhs, the small players are actually paying no punitive damages. What then unfortunately happens is, if you become a big enough player, you are exposed to fines. If you remain a small enough player, you go under the radar. It is like a perverse fine that is being put on, unfortunately, on people because you're more visible. So what that does is, 90%, 95% of the fintechs, insurtechs, others who are there, they say, what's the real need of investing? What is the real need of investing? What's the real need of sort of getting these in? They start getting into trouble when they have to go beyond India. So if you go outside of India to Southeast Asia, you go to other places, then you suddenly realize you need to have these compliances and risk norms in place. So I would say the first problem is cultural, where the culture of saying, you know what, I can take this risk, even if the government comes to me tomorrow. There are only two actions. Either I will be allowed to do my business. The second is, like it's happened with those apps, my business will get shut down. There's nothing in the middle. That's one. The second problem is, unfortunately, when you're the smaller fintechs, cost-effective solutions just don't exist. You have the big solution providers who are doing $2 million, $3 million, $4 million implementations. But if I have only 10,000 transactions, 20,000 transactions, 1 lakh customers, there are very few solutions out there in the market that I can use. So it's a very underserved market. And I think till these two things don't change, culture as well as access to better technologies, we'll continue to have that problem.
I think, hope we see some traction in that front, especially with emerging technologies coming our way. And just like COVID with our vaccines, it's going to continue to evolve because we always think that what we have today is enough, but I think it is never enough. And we have players, and just now I was just getting a call on the Truecaller, it said loan scam, right? There can't be a better way to get a call like that with the Truecaller. So I definitely know there is something happening behind the scene that we're not aware of. But to pivot to the next level, go to Badri. I mean, when it comes to new technologies, when it comes to automation, when it comes to practices, what are some of the things that you think are going to be enabling and what you see is or foresee coming in the next few years to come from your perspective?
Yeah, thank you, Ninad. I resonated a lot with the points that were made. The speed of transactions are today being enabled by easy availability of APIs, payment systems like UPI, and so on. But what we are also seeing is that it is quite difficult to actually make end-to-end journeys in any fintech transaction completely automated. At least the sector from which I come in is insurance. If the theory is that end-to-end technology systems can help in automated checks and balances and algorithms and ML which can learn, in reality, I can say that apart from very low-ticket insurance policies, most indemnity policies in India that are sold, which are health and life, they necessarily need a medical examination, or they need a lot of form filling to be done, or a proposal form to be filled. And those are actually sources of risk for us. Actually, it's very difficult to scale indemnity business extremely rapidly in India. Like lending has shown time and again, it results in massive NPAs or outright frauds. The same situation in insurance as well. Rapid scaling becomes difficult. So the things that we focus on internally at Turtlemint are where we cannot fully automate. Can an RPA tool help? And we're working with some RPA providers. It seems to kind of do the work that a very junior employee typically does: look up policy details, enter the right policy details, or check for a few things. Some simple machine learning things. Can I read a policy and can I pick a few details from the policy, populate it into a table? Simple machine learning PDF readers. We're doing a lot of that investment. It's not automation, it's not end-to-end technology, but it certainly seems to speeden up our ability to scale the back end, because otherwise, one, the business teams are easily able to get headcount to grow the business. But the compliance and the regulatory teams are always saying, "Aapko 10 log chahiye to 5 log le lo na." So how do you kind of look at underinvestment in controls and compliance teams and organizations? Then we increasingly resort to some of those. The second thing we find having conversations in our own Mancom, the senior management team, is that how do we kind of keep re-architecting our core systems? And this is an important point. I do not know if other fintechs go through this as much as we are going through, at least. Uh, we find that our partners, such as insurance companies or other distributors, they operate on legacy infrastructure. Some of them are COBOL systems. But we would like to think that we are on REST APIs and so on and so forth. And every integration, every UAT, every new feature release takes an extraordinary amount of time. By the time it feels like we have missed the business opportunities, or we have allowed too much of a risk to enter into our system. So we find the need to constantly re-architect the systems to make our own journeys much more easier, faster, secure, and keep addressing the risk. Now in that, hiring a lot of people. Actually, the technology cost for our business is extraordinary, to be honest. And I won't say everything is innovation. Most of it is redoing things that were built about 5 years ago just to adapt themselves to the new realities that have emerged today. So we're certainly investing in these areas now. A lot of re-architecting, so end-to-end journeys or to adapting to new realities. A lot of RPAs to kind of solve for situations where end-to-end fintech journeys are still not possible, at least not in insurance. Things that enable us to scale without falling flat on our face, to be honest. I hope that was helpful. So,
Perfect, thanks. But when we look at compliance and technology and some of these enablers, Sandeep, do you think that historically, legacy, if I were to call it 15 years back, the organization will have set of teams? One will do an X perspective, they will do pre-screen, other will do go deep into it, other will get into it. Now that was more on headcount dependent processes that were formed already. Are we seeing a shift with new technology that are emerging, or are you seeing something where technology is helping us be better equipped to identify and to also process information and then put certain controls that some of the fintechs, banking providers are able to, I would just say, absorb that to their benefit?
Sure. I think it is, and what we are seeing is technology is definitely helping in different areas, including helping, improve the speed of transaction which is, required. At the same time, like you rightly said, the challenge that was there earlier in terms of different people doing different things and lack of handshake between different people, that continues to exist. So that used to be there earlier between people, now it's there between different apps, okay, or between a combination of app and then people. So a lot of times what is, happening now is that there is a kind of a blind reliance on technology that is, happening. Okay, this is the technology, it will do everything end to end. From a compliance point of view, I'm talking about right now. But there are certain elements they do it, certain elements they don't do it. So that handshake between the process that is happening before it goes into the system and then subsequently, that handshake is still not there, and that's where I think it is leading to some of the bigger challenges. So that's how I'll summarize.
But do you think with this lack of handshake, or which is still needs to strengthen further,
Yeah.
are there loopholes that we need to be aware of? Because this critical gap can lead to far more emerging risk than we ever thought. We were thinking that, okay, the system is doing something. I, as a human, is entering something and passing it over, but I missed, I dropped the ball somewhere, thinking that it will automatically flow in. Can that create a vacuum in the way we see this, this emerging areas of risk multifold in some way or the other, and then wait for another technology enabled to happen to further address that gap?
Absolutely, and like we are seeing in every industry, where I think people have not, addressed this gap between the different handshakes that happen either in the technology or between the technology and human intervention. In this industry also, if we don't address that gap, it's going to lead to a catastrophe. And especially if the business model is built based on that, then it's going to lead to a bigger issue.
So, Nishkam, what do you think in your experience and what you're seeing right now? Do you think that we need to be more adept to technology, but not completely relying on technology? So according to what do you think, where is this going to go? And how can solution providers with further assist you, or the fintechs, or the people who are involved in this, to be more, I would say, involved, be more informed, so that, because there's an investment required, like Badri said, there's an investment that's needed. We may oversee the investment that's needed for now, but times to come, we'll have to create a separate budget for that, just like any other expenses that we. So, what's your view on that, and how do you see that changing?
Well, absolutely right on the point there. I think the traditional way of banking has changed, right? So you can't be complying to the laws and regulations in the traditional way then, right? So the way that we are doing business as in fintechs do business, I think it's much more different than how traditional banking was happening. As you touched upon, speed of transactions, KYC, right? KYC may not be just anymore just identification of the customer. You have to look at segmentation of the customer, because the volumes are huge here in fintech, right? So you need to segment your customer. How he's behaving within his segment is something someone has to look at. And as he rightly mentioned that, the top of the shelf solution which is available for an AML or a FinCrime compliance for a commercial bank may not be at all suited for a fintech solution, right? You may need something very specific for fintech, and which may be specifically required to be implemented there based on different silos, as we were mentioning about, whether it's fraud monitoring, whether it's anti-money laundering, whether, how do you marry those together in one solution and look at this. So investment in technology will definitely be the concern for the fintechs. Having said that, also look at what regulators are looking, right? They are also looking at combining all kind of FinCrime compliance under one solution, one umbrella. So while we have different teams in the organization sitting and looking at different kind of alerts, I may look at fraud, someone else is looking at anti-money laundering, and they're not talking to each other. The regulator may not look at it that way. So I think those kind of future thinking, organizational changes or harmonization within the teams which are sitting, and the technology that they are using is going to be required by the tech solutions.
Abhishek, you may have a view on that, additional insight, because it's interesting that while there are technology, emerging technologies for banks, financial institutions, a lot of the technology is based on how the data assets are getting aggregated to provide that information through a technology. Do you think any of the solution that we think will complement some of the inherent need for such an information tool, the technologies? At present, what do we have, and what do you think is going to come our way?
Sure, thanks. There are essentially two types of technologies that are at the cusp of lots of innovation. Two types. The first is human interacting with machine. The second is machine interacting with machine. So to give you an example, if a machine interacts with a machine, that's an API. Two machines talking to one another. The other is human interacting with machine. So what does that mean? A great example, which I also was on a panel yesterday I spoke about is, and I'm sure we've all heard about it, ChatGPT. It is a machine talking to a person, right? Those are the two different types of technologies that are getting implemented in different places. Where you need speed, where you need scale, you need machines to talk to machines. Where you need intervention, you may need a machine to talk to a person. Those are the two different types of technologies. If you're looking for at scale, if you're looking to solve something at scale, having a human in the loop will mean you need to have machine and human interactions. So for example, what is artificial intelligence, machine learning and all of that? That is a separate issue that that the tech is right now far more ahead of what regulators are willing to accept. So for example, I think a lot of companies want to get into machine learning and artificial intelligence to solve some of these problems. Where they fail is the fact that the regulator says, please explain to me the decision systems. If today you went on to ChatGPT and said, where does the sun rise from and what would happen if the sun rose from the west? ChatGPT will actually give you an answer. But if a regulator was sitting there, the regulator would say, can you explain to me how ChatGPT got that answer? And not even the data scientists who worked on that can tell you exactly how it happened. Because it is trained on a statistical model. So to say machine learning and AI are going to completely change things, probably not going to happen in highly regulated spaces because the regulators are going to ask for explainable AI. So that's a black box. Where I think the real innovation is going to happen is between machine and machine interactions. Because that's scale. So for example, let me give you another example. OCR, right? OCR is a great piece of technology that we don't talk about. The more you make it better, because OCR is taking documents and is feeding it into a machine. That's machine to machine interaction. So I think a lot of investments will go into that. That's one. Automated fraud sort of red flagging. That's machine to machine. Transaction monitoring, machine to machine. You will have then, let's say, your Aadhaar PAN verification that is now happening, machine to machine. So I think a lot of investments will happen in machine to machine, and they should continue to do that. And I think anybody building a business model should look at machine to machine. But to the point that was raised here right now, the reality is that on ground you need people. You need people, you need feet on street, you need compliance people, you need all of that. The challenge is going to be is that the regulator is going to say, show me proof that how does this work. So I would say there are a lot of technologies out there on the machine to machine side which are doing very well. Machine to individual, I think something like ChatGPT is going to completely change things. For example, summarization of news articles. There was a time when you had to sit down and you actually paid people a lot of money to summarize news articles. Their job is gone, completely gone. If you went out today and you said, can you explain to me what happened here? It's gone. Similarly, if you said, okay, explain to me, recently it happened, I think I showed it to you also. We were looking at hiring, for example, a content developer to write content around AML screening and this and that for our blogs and everything else. I just put that content and I said, please write a blog post on AML screening. ChatGPT did it in under 2.5 seconds. So that content person's job is gone. So what will actually happen is a lot of this machine to human interaction may mean that the total number of people that are involved in this will actually also come down. Those are the two sets I would say.
That's interesting. So, like always tell people, when we're looking at artificial intelligence, it is still artificial at the end of the day. It still needs a real intelligence to feed into the ecosystem of artificial intelligence that we all use. And I think it's going to be important for us to see that where do we invest in artificial aspect, increase the speed of response and the transaction time, and definitely get the result that help us comply, helps us identify emerging risks that come our way, and then obviously act on it quickly. But pivoting to the next stage of this conversation, where do you think fintechs are today when it comes to emerging risks in financial crime and compliance? And what do you think, both insurtech space and fintech space, where do you think they need to be prepared for the future? So, Bharat, let me start with you from the space because you have watched this very closely in your experience. And what do you think this space should be looking forward to?
Regulators are getting quite worried about systemic risks in fintech, be it lending apps, be it rapid expansion of risks being sold by insurance companies. So they are starting to get more prescriptive. For example, the insurance regulator, I do not know how many of you know, doesn't simply say the company needs to have so much solvency. It also says in what proportion your expenses and P&L have to be. And then they go on and say in what proportion your claims by type of policy needs to be. That is them doing their best. It still doesn't help in solving for risk management in the industry. So we are seeing emerging risks from regulators doing a lot of one step forward and one step backward, and kind of using blunt mechanisms to try and kill systemic risks in the economy. We spoke this morning about how there is extensive, maybe going beyond the remit of law, sharing of data between various regulators as well, where let us say the revenue departments or the law enforcement departments are sitting around a table and sharing information with each other even more than they are permitted under law. They feel that they need to do it. Otherwise, there's some huge risk will emerge and it will become a Lok Sabha discussion and some ministers will be sacked. And somewhere some of these things are becoming real investigations on companies. It's becoming real companies. And we are quite unsure sometimes in how to respond to some of these inquiries from regulators saying, why are they asking us this question? What context? How are they getting the data that they're alluding to? Why have they jumped to a certain conclusion that we have not seen ourselves? So there's a lot of asymmetry happening between the risks that we are seeing and the risks that the regulator is seeing. And sometimes it's leading to litigation. And we also said that relative to number of investigations, number of prosecution is meaningless. That's a classic symptom of sheer confusion in the economy. So many investigations, so many searches and inquiries by departments. But in the end, it all seems to be one grand misunderstanding. But during that time, there is tension, there is a lot of loss of momentum. It hasn't helped really in solving for risks better. So we are all investing a lot in compliances. We're investing a lot in automated compliance tools a lot. We're investing in a lot of RPAs to kind of try and get ahead of the curve as much as we can. And at the same time, we are fed by venture capital money to keep growing as aggressively as we can. Today, the stress on operating management teams is quite high to try and meet growth expectations and meet risk management expectations. I think we'll continue. The net result of it, we'll see a lot of investments in core systems, core system re-architecting, risk management. I see that happening in my business, and I think it's happening across every fintech today. So this is the theme for the next few years for us.
Excellent. Sandeep, what do you have to say on this?
Thanks. I think I would cover from different perspectives. I think from a regulator perspective is already covered. What are the risks? I'll now cover from an investor perspective. So because we do a lot of work on behalf of investors into the industry. I think 2-3 risks that we are seeing in different diligences and investigations that we see, how investors look at it is, first is how is your business model based at? Is it based on a particular sort of unique thing that is there in the industry which nobody can replicate, or is it based on certain things that if the rule changes, then you have a challenge completing your journey. I'll give you a simple example which is now in public domain, relates to insurance industry but applicable to all, is the entire concept around overriding commission. Lot of, I think, insurtech companies popped up, substantial revenues through the overriding commission that used to, sort of come in because somebody had to manage that, process. So that was lying in a kind of island entity, and that amount was being used for various, purposes. Suddenly, I think GST raid happened at one of those entities which was managing that, kitty, as it was called in the industry. And then everybody, I think, came under the radar. 16 insurance companies were raided for that. These agents were raided for that. Now, I think that entire, scheme is under scrutiny of the regulators. So investors are now worried. So those who are planning to invest in such companies have taken a back seat right now because they feel that if this was a substantial contribution to the margin that we had and it may not exist tomorrow, then we have a challenge. So that's one risk that they are seeing. Second risk that they are seeing is in terms of what is the, system and technology that is available to make sure that there are no frauds happening within the organization. Now, those frauds could be of two kinds. Primarily, that what we are seeing is, one is fake customers, and they are happening through synthetic accounts, various other methodologies that are there. I think the latest case study that is there, which is there from US right now, where $175 million was paid by a large, global bank to a, founder who started a company, showed that she had more than 300,000 customers, and then expanded to 1.5 million customers. But when they started to monetize their data, the entire valuation was based on monetizing that data. But when they started monetizing in the sense that sending mailers for other products to those email IDs, the email started bouncing back, right? So, and $175 million was paid over there. And that's an example, classic example, where investors are worried that whether the business is real, is it scalable, or there is some other challenge over there. Third risk that we are seeing is the entire technology that is built in. How secure that is from 2 points of view. Whether that technology or the source code that is used from somewhere else, that's one, or are there employees who have taken this source code and starting somewhere else. Both sides of challenges we have seen, wherein there are cases also in public domain, both in fintech as well as insurtech, where people have taken source code, some employees who are there working with the organization took that source code, started with somebody else, and then later I think it became a kind of a legal battle between the two. Business took a back seat, investors were worried. So that's another angle that investors are looking at in terms of this model that is built specially around the technology, how secure that is, it is, and then will it, I think, make sure that nobody else claims ownership for that model.
Perfect. I think what you touched upon, great thing. Internal and external risk, they coexist even today and will continue to. Emerging technologies continue to mushroom. With that will come more risk internally, because I will exactly know where there is a gap in the system that I can take advantage of, right? But Nishkam, in your view, when you are interacting with some of the clients, customers and all, in your field, how do you see this playing, that the banking ecosystem of the fintechs, insurtech, they need to be watchful of?
Absolutely. Absolutely. I think, as Sandeep earlier mentioned, that this is no more just a compliance function in the organization. This has become a boardroom discussion, right, at all organizations. I think that's a pat on the back of the compliance officers to get the discussion, importance of those discussions there. The regulators are all across, and they have been, I was talking to one of the clients yesterday. They just went to a meeting of regulator. Regulator just handed over them a few transactions which have happened in their organization, and then told them, this is what we have found out, please look into. So there is no formal request coming, but you're on a compliance, he's petrified. He knows that these are transactions in my organization which the regulators has found out, and now they've given it to me, so I have to go and do a lot of homework background. So, that kind of, indulgence, regulators are looking at it. So non-compliance is definitely not an option, I think, and using technology is always going to be important there, as I earlier mentioned, right? What I was looking at is what Badri was mentioning. While you have a lot of people looking at different things, you need to identify places where you can use machine talking to machine. If someone is looking at a very basic of just there's an alert which comes on the name of Nishkam Ojha, whether he's the same Nishkam Ojha or not, that can be done by a machine itself, right? I don't need to, sit someone match those balances. So identifying those spaces where you can use technology. Compliance definitely, regulatory compliance is always going to be there. The problems will always going to be there. The important thing is how, as an organization, when these events occur, when the regulators come knocking your door, you are able to demonstrate that we have all the whistles and bells in the place, and we are complying with it. We have controls in place. If you can demonstrate it very well to the organizations, the incidents which occur may not be seen as systemic risk in the organization or the industry as well. So that's my view on that. Right?
Perfect. That was great. I think we probably would be running out of time soon. I'm already getting some hints. But before we do that, there's some great conversation, but we'd like to just summarize and wrap up. That we talked about compliance, we talked about AML, we talked about technology, and how we need to adopt. We also need to adapt to changing situation, and definitely have a stronger governance and more focus on it than it has required in the past. With that, I'd like to hear some closing comments from Abhishek. Let me start with you. As to what do you think we should be looking forward to in the years to come? And, there's some interesting time. Hopefully, I think by the time next year when we meet, we will have much more information to say that, see, we said something a year back, and you're seeing it happen now.
Yeah, right. So I'd like to pick up the thread on emerging risk, because risks can be treated a little bit like, if you understand the psychological concept of Johari window. It's basically, you take a window and you put it in 4 parts. It's basically a matrix. And you say, I know what I know is on one side. I know what I don't know is on the other side. I don't know what I know is on the third side. And the fourth side is, I don't know what I don't know. Emerging risks are actually in the 4th part. I don't know what I don't know. I am not aware of even the risks that are probably out there. I'm not covering from them. I don't care about them. I don't know where it is coming from. Very natural for every business and every individual to have their priorities in all 4 of these boxes. So But the problem is the real threat comes from the fourth box, right? What we focus on is, I know what I don't know, which is I should be complying with this. I know this is a risk, but right now I am taking it easy because I've got budgetary constraints or I've got regulatory constraints or I've got everything, and that's absolutely fine. You'll probably, that's what we aim for. The fourth one, which is the emerging risk space, is what the problem is. And I think how we will deal with it is actually a very old-fashioned and very boring idea. And actually that was made sexy by Nicholas Nassim Taleb, who wrote about Black Swan. He wrote a follow-up book about anti-fragility. And what he said was in anti-fragility was, we should consciously make organizations in such a way that tomorrow when there is an external earthquake of sorts, the organization ends up being stronger in certain ways than what it was before. There are many such institutions and many such things like that. For example, the human body is anti-fragile. If you give it a lot of exercise and this and that, it actually becomes stronger over a period of time. Now, while that is a great thing theoretically to say, problem is many companies live quarter to quarter. And when you're living quarter to quarter, you're worried about becoming faster, you're not worried about becoming anti-fragile. But the only way you can have a long-term sustainable business which is going to deal with risk is if you build in anti-fragility into your organization. And anti-fragility means, if you're a fintech company, if you're an insurtech company, and this is the conversation we are having, risk is your business. And if risk is your business, that means you're investing in technologies, you're investing in people, you're investing in skill sets, you're always on the lookout for a horizon for potential risks that you can capitalize on, you can actually build on. So I think that's going to be a big differentiator, and that would be my view on this.
Perfect. Badri, some last comments on the stage? Just hold your mic a little bit closer.
Yeah, sure. No, I actually very well put, to be honest. I don't have too much more to say. I'm hoping that in the next couple of years, this uncertainty that we are seeing in the regulators' overarching actions or investors' nervousness about how this will kind of settle in the next couple of years will get settled. We are in a correction phase when capital was available and many startups were being born, and regulators also can't look at every problem on earth and try to solve for it. They also want some problem to scale up before they can pay attention to it. Same for investors as well. I'm hoping the next couple of years is a bit of consolidation. Consolidation of service providers will naturally happen. Plethora of startups will get bought, will get consolidated, which will lead to better risk management overall for the industry. More capital will be available to manage risks than before. I think some of those things I'm looking forward to. And then truly create long-standing institutions in the country. There are great examples of Bajaj Finance and Bajaj Capital which have dealt with several business cycles, offer credit at scale, and they seem to withstand risks better. They seem to be anti-fragile in some ways. We will see more of those institutions coming up. So I'm an optimist that these are all learning and we'll all become anti-fragile.
Love that optimism in the space. There's too much of pessimism that's
So I
happening
think,
in the recent past.
yeah, so I would say that next 2 quarters, right? Since I think he said people live quarter by quarter, so I'm saying that next 2 quarters, we are at an inflection, point where there is some kind of, for lack of a better word, disruption that is, happening. So you have the regulators on one side, so we need to, deal with them. You have the investors on the edge right now, so not necessarily availability of capital with ease. So there will be more and more scrutiny. Then you have the talent challenge, which still exists from both sides. The attrition still is high. And second, getting the right people is not, easy in this industry even now, because there are not that many trained, people. So in all this environment, what happens is people would focus generally on, sort of building the business, retaining the business, getting the capital, etc. and all. And compliance, generally, in my experience of 25 years, takes a backseat. And that's where I think it comes and hits back very badly. So it's important that while we take care of other aspects which are critical, because if we don't survive, compliance is not, relevant. We do survive, but at the same time comply and ensure that we are not looking at compliance as an additional, cost or something that we can, sort of not do right now. Let's focus only on, retaining the business. That's how I'll summarize.
Excellent. And finally, Nishkam.
I think very rightly put up by all of them, and just very positive on how things are happening within compliance, within the fintech. I think fintechs have been very great in making up that industry, making up that business, their mark here. I think it's all about now finding that balance between business and compliance so that we can survive more substantially. And the regulators are always going to be there. So I mean, identifying technologies which can help fintechs themselves to comply with these regulations is something that is to look forward for all of us, I guess.
Excellent. Thank you so much, everyone. It was great having conversation. Do we have 1 minute? Any questions if the audience members have that you'd like us to? We don't want to stand between the lunch and the compliance risk. And we are hearing a lot of plates making noise outside. I know we're all eagerly waiting to go out.
You're asking
But
questions
think-
at the wrong time.
I
man.
think,
They've gotta have lunch.
we can connect with all of you offline
Perfect.
over the networking.
Perfect.
Thank you so much once again
Thank
for
you
the
all.
wonderful contribution and
Thank
for
you so
joining
much,
us with
everyone.
your valuable time. We really appreciate your time and presence.